Just think about it. The baby boomers alone hold more than 54% of all the stocks on the stock market. And these people are either retiring or already retired. Not to mention, yesterday I watched a video where the new companies who are trying to take over the credit card businesses are buy now, pay later. And the three companies that currently are competing with credit card companies. And effectively, they're in some way operate like a credit card company because they still charge you a late payment fee, which happens to be an interest, which is the same system the credit card companies uses, right? If you really think deeply, Mark Zuckerberg is kind of a Jim Cramer in the technology sector. Think about all the predictions and investments that he and his company actually did and quite went completely in the opposite direction. Think about the Metaverse, think about the VR headset, acquiring companies here and there. $20 billion completely lost. They just recently closed not only the project around the Metaverse, he fired all the people who were actually working on the Metaverse. And there are many other different projects. I got reminded by Perplexity, of course, that illustrate that in some form or shape, if you are able and capable and kind of interested to follow the both sectors, the stock market, the Jim Cramer, the person who is usually mocked for being wrong and then trying to fix what he said, betting on the opposite side, being wrong again. One of the greatest of all time was when Meta fell under $100. He apologized that he was bullish on Meta. The following year, Meta made all-time high. The best performing stock, very close to Nvidia. Percentage-wise, was actually bigger than Nvidia. So again, Jim Cramer was very off this prediction as well. But the main point here is that if you zoom out, considering the current acquisition from Meta in Manus AI, right? If you just follow the AI sector, of course, if this is something that interests you, you probably will be more interested to follow the development, and maybe we're actually experiencing the top in the AI boom, because these guys were late big time for the AI hype, and they figured it out, and they didn't want to miss the train, and they doubled down. Something very opposite with the Metaverse. With the Metaverse, they thought that they're the first one, they're the innovators, they're the pioneers. That's why they doubled, tripled on $20 billion. And in the end, they were the only one in the room. There was no one else investing in the Metaverse. Even people who purchase land, sell land, develop games in real estate in the Metaverse. Remember, people were saying the Empire State Building in the Metaverse. People were saying, smokehouse next to the Adobe house. All these pretty, I would say, comic book realities where a lot of people were buying, and the prices were, $3,000, $4,000, $5,000, $6,000. Some people flipped this virtual land, make money, but the overall concept, the whole idea of Zuck, the person who was a human, right? Before, it didn't play out. It didn't play out because the people didn't engage. And even Microsoft tried to help the push and the adoption of the VR headset. I personally went here to the flagship store on Fifth Avenue in Microsoft on the second floor to try the VR headset, try to, understand what is the whole hype about. I didn't find it engaging. It was uncomfortable, heavy. I don't know, maybe very young kids. Maybe they tried to kill some time, but it was boring. Then Apple, right before Zuck, leave the project and fire all the team. Apple picked up from the same spot, but they implemented the whole new reality. Remember this 5000? I forgot what was the name. It's like Apple Vision Pro or something like this. So yeah, but the concept is completely different. You, in fact, can work from this device that Apple built versus the Zuck, where he was like hang out with friends and like a WhatsApp virtual reality world where no one actually was interested. The point here that I'm trying to make, of course, let me remind you, we just stretched for a while, is that if you really see and read between the lines, Zuck might actually be the Jim Cramer in the technology sector, and he might actually be the indicator that you want to follow if you're investing in some of these AI companies that Meta either acquired or is planning to acquire or is partnering with. Again, this is do your own research and due diligence. For my own personal consideration, I think that the Manus AI is overhyped. Nothing unique. I haven't seen anything that the other chatbots cannot do. Also, it's slower, it takes much more time for research and deep research, and especially building projects. You have less credits, more expensive, so many disadvantages. But again, Zuck probably has seen something that we don't know. I might, of course, be completely wrong, but if you just look at the pattern, if you look at the previous performance, you can kind of predict or have certain expectations about this project. Let's wait and let's see how many years it will take for the Zuck to close down this project as well. We already heard maybe in late November he was stopped hiring for the AI super intelligence team, right? Which was another indicator that, oh my gosh, we kind of overhired, we went off the rails type of situation. I don't know, it's just interesting. If you can, I understand it's very hard, but if you can follow two different domains of knowledge, and if you can spot similarities, and if you can spot the similarities and draw your own conclusion that is non-biased, right? You don't have to listen to me or anybody else, but like I spot this for myself, right? So I'm gonna make my own financial decisions based on what I see and the conclusions that I draw from it. But you can do the same exact strategy on something else. You might be into e-commerce, you might be looking at what Shopify is trying to acquire, or what kind of apps Shopify implements. Remember, Shopify built a special payment app separate from Shopify. It was the Shop app, right? So you have to follow the whole infrastructure around the niche or the domain that you are actually making money, or you're investing, or maybe you have a career in tech, or maybe you really want to see what's going on. But like I said, if you can build the same system where you follow the trend, analyze the news on your own way, and create a comprehensive framework, okay, what this means, what I'm gonna do, and how I can actually either protect myself or make money from it. Are you gonna be waiting to see 2026 or 2027 potential recession, drawdown of the stock market? If you started investing 30-40 years ago, you're up 6,000-7,000%. Would you be waiting to see what the market has as a surprise for you? I don't think so. The problem here is that a lot of people speculating that these guys might be selling. And I understand this is a very large speculation. Why? Because if you look at the historic data, how these people actually vest their retirement funds or retirement accounts is usually on 4 to 6% on an annual basis. They're taking profits in these ranges, but like I said, this time around is different. Why? Because the market is at all-time high, and there is a major shift in the economy coming from the AI sector, which means a lot of other stocks that these people have been holding throughout the last 20-30 years may not see another high, right? We saw this with many companies that have been doing well, have been doing all right, have been paying dividends, some of which. But if you realistically see that some of these companies have no connection with the AI, they have no upside, they have no partnerships, and they cannot be left behind in this trend, well, you really want to prepare yourself for potential $25 trillion worth of securities and value being at some point maybe gradually dumped on the market. Because again, remember, these people, they don't have the time to recoup the losses, the potential losses, if the market actually sees a major correction. And why would you risk, right? If you're like, 60, 70 years old, why would you risk? The second positive flip side on this speculation is that if these people sell, there's going to be a buy side. It's going to be a lot of these asset managers, maybe BlackRock, maybe Vanguard. It will be a lot of Wall Street investment firms who will jump to buy the dip. They're not going to be buy the first dip. They want to make sure that all of the retirees are finished selling. Then when the market establishes potential new bottom, they will be start buying. And this is the moment where most likely we're going to see a lot of retail investors. So it's not going to be as bad as you can imagine, right? 54% drawback. But remember, the usual strategy in the past was when you taking 4 to 5% annually from your retirement by selling stocks, you shift to something that is less volatile. Also, has appreciation upside, maybe smaller one, but also has much less risk. The problem here is that they really don't see anything that is, alternative where they're gonna go. Because sure, they could sell this 54% worth of stocks, but they're not gonna sit in cash. If you watch my previous video where I explained $2 million today will be worth $750,000 in 40 years, or it might be even less than 40 years. So these guys, if they sell, they're not gonna be sitting in cash. They're gonna be buying something else. And this is where the unlock might be coming for real estate, because also looking at the historic data, a lot of these people will not be spending this money. They want to make sure that they leave some of this wealth for inheritance, and this is why there is a speculation that they might actually shift a lot of this liquidity towards real estate, which again might be good news for the real estate market, which this year I would say has struggled big time. So it is a good thing to keep in mind. Millennials hold around 8% of the stocks, which is very small, and I would say not gonna have any impact on the market. There's a big investment firms or retirement funds that could scoop this 8% if really there is some correlation of sell-off or exiting the market. But for this 54%, I think it's a bigger deal, especially considering that there will be probably some changes next year on taxes. President Trump is really working towards different things that improve, or at least offset the economic hardship. So bear this in mind, okay? Expect something that a lot of people don't really know. They don't really expect this to happen, but like I said, you need to put yourself in the shoes of these people, so you will be able, unbiased to think about, right? If you are 60s, mid-60s, 70s, and you have a portfolio, your 401k, Roth IRA, whatever, personal 401k, would you be waiting to see the surprise that is coming next year? The market might make new highs, sure, it's possible. We have OpenAI IPO expected, we have SpaceX IPO expected. Many things could happen. But the idea is this going to be just a few runners rally, or this will push the whole market? First of all, if in 2026 we have an economy, specifically the US economy, booming, and if we have the GDP breaks the estimates, we're going to have gold not only sell off, there is a potential crashing gold, because if the economy is booming, there is something called opportunity cost. All the big investors, being individual, institutional, or even governments who currently hold gold, they're missing so much on gains and returns not being invested on the stock market, on the crypto market. So there will be a major capital allocation if the US economy is booming. This is your number one catalyst. The first report for the GDP, you have to pay very close attention to the estimates. The second important catalyst is the interest rate rise. This is kind of confusing. A lot of people might be thinking that if the interest rates go up again, or we didn't see more rate cuts from the Federal Reserve, well, this might actually be beneficial for the gold prices, right? That's not really the case, because if the interest rate remain high here in the US, well, then this simply means that the gold and the interest in gold might remain elevated here in the States, but the interest outside of the US might not be as high. Because remember, if the interest rates are high, if the gold prices are high, this means that we're having a weaker dollar, which is very beneficial for all the other countries who are essentially importing goods from the US, right? Because the dollar is cheap, the export is very cheap. This is why there is a universal law where it is always a principle in the US economy where you don't allow the dollar to become so strong, because this will disrupt import-export mechanisms that are in place. So this is second very, very important catalyst you want to pay very close attention. And third one is, of course, the dollar. So far, we already mentioned that the prices of the precious metals, the gold, the silver, even the palladium, even after the crash, have been elevated not because they're more valuable, not because there is more demand for it, but simply because the value of the dollar has gone lower for the money printer. So this means that the rebalancing, if the rebalancing reappears, which means the dollar regain its value, this means that it will pushes automatically all the precious metals on the lower end of the equation. Also, more powerful dollar, like we mentioned, will be equivalent again to stronger GDP, which brings us back again to point number one, the first important catalyst. So everything is kind of interconnected. It might be a little hard to follow up if you didn't study this in school, if you didn't have like economic or finance degree education, but I believe it's very simple if you just at least read the news, follow the news, every single economic report that comes in, you can read. They're not necessarily 100% accurate. They don't really tell you exact numbers. They always give you a ballpark, which is most likely not accurate, but they give you the directional trade. They give you the direction in which things are going, right? They cannot give you completely opposite prediction or estimates when things are going in the opposite direction. So again, a lot of people are hoping for very strong 2026 for precious metals, which indicates a major disruption, which means that risk of assets will be crashing if the gold continues the rally, which means bad year for crypto, bad year for the stock market, which also means bad year for dollar. And yet, if you have a continuation of the depreciation of the dollar, imagine every other currency around the world, what kind of struggle they will have. And just today, China also announced that they will suspend exports of silver. And China is the biggest producer of silver. What is this even telling you? They're trying to hedge against the evaluation of their own currency, because, like I mentioned, if there is a bad news for the normal currencies and they see the depreciation of either money printer or we're having a debalancing of the national currencies, they're gonna look for something that will hold the value of their country. And this is why we're seeing with China, right? They are going to suspend the export of silver, which is, again, not a big deal. People are broke, not because they don't make enough money, but rather they spend more money they make. And to illustrate how true this is, if tomorrow everything disappears from the market, anything that you usually spend money on, no coffee, no Starbucks, let's say transportation is free, let's say you only go to work, get paid, and go home, you will simultaneously see how much of your usual expenses disappear, and you kind of can live with all the money that you're currently earning. This is the same misconception that the world is overcrowded. All the while, a recent study found that if you gather all the people from all the countries, put them in Australia, it will be completely enough to fit all the people living normally. So obviously there is enough space. Obviously most people can live normally with the money they're making. Of course there are exceptions, but we're not focusing on exceptions. We're focusing on actual rules and the patterns. People overspend. I've seen plenty of people, friends of mine, friends of friends of mine, they spend money that they don't have. And the idea here is that the spending habit is kind of a hobby. It's kind of a lifestyle hobby, because if you live in the big city, like if you live in New York City, you don't have to have a hobbies that people probably in Florida and Miami have. Like every day off or time off you have, probably go to the beach, probably go and you do fishing, probably go and do jet ski, right? Every free time that you have here with your family or with your friends, what you usually do, you go out, you eat someplace, and then you go shopping. People spend 80 to 90% of their free time shopping. Like everyone has tons of clothes here in New York City. So I come to realize this because I didn't grow up going to the mall. I hate going to the mall. As a teenager, my friends say, let's go to the mall, let's watch a movie. I always hate the mall. I didn't see any purpose of it, right? Going shopping and all this nonsense. But the area where you live kind of shape your lifestyle, kind of creates a pattern of how your working days, how your free time will look like, where you're gonna spend your time, how you're gonna spend your time, what you're gonna spend more money on. I'm telling you, people that I've communicated recently, they spend more money on shopping than money on food. In some cases, they spend even more money on shopping than money they spend on rent, which is crazy. So this is why when you choose the place that you want to settle, it's very important to understand the change of lifestyle that comes with the area and place you live, right? So if you live in Miami, like I said, I don't see myself shopping every day. I see myself being in the beach all day long. I don't care about the mall. I don't care about sale. I don't care about anything, right? I don't know which day is Black Friday. I don't know which day is what was Cyber Monday. I don't really care. But because when you live in the big cities, you kind of stuck in particular pattern. When you see almost everyone is doing the same thing, almost everyone is spending their money on the same areas of the city. They're spending on the same items. You see them on the same locations, and this is kind of a limited belief syndrome where a lot of people are having a hard time to come up with original ideas to spend their time and their money in a way in which it really makes sense for them. Because most of the people that spend all this money that they don't have, they usually buy stuff that they don't need. And the crazy part is that they try to impress people that they really don't care. It's kind of a self-humiliating way of overworking yourself to keep up with the Joneses, right? But that's the actual truth. I just recently realized this. Because like I said, I didn't like shopping. I spent all my teenage years, wearing tracksuits, playing soccer, playing football on the field with the boys. I didn't really care. I didn't have like pair of jeans maybe until I was like maybe 16 or whatsoever. I didn't really care about fashion. But look at me now. Everything is like arranged by colors, by patterns, by materials. Everything is like I got like so interested of all this stuff. It's crazy. You need to have this second thought before moving to a particular area, because the area will shape you. It's not gonna be you the one shaping up the area, and the area will shape you. And if you don't like the way you're shaped by the area, you're going to relocate. This is what happens with a lot of people. That's why they're moving. They're buying boats. They become fishermen. They spend every afternoon down on the flats. They find their hobbies. Why so many people in Palm Beach play golf? Why there's so many golf clubs over there, not so many golf clubs over here in New York, right? Here in New York, we have plenty of marinas, we have country clubs, right? But it's just a different type of a lifestyle that shape New Yorkers, and different lifestyle that shape people down in Florida, and people in California, and people in San Francisco, right? It's the area that shapes the people, the lifestyle, and of course, how much and on what people actually spend their money on. And this is where the shift that I began the video with is that you can really fit the lifestyle in the area you live if you stop overspending more money than you're making. Most people just go with the flow. Everyone else in my building, let's say, spent X amount of money on these items, I'm gonna spend it all, regardless that anybody else makes more money than me. That's the most outrageous part, is that people do not really compare their lifestyle with their actual earnings, which is the biggest discrepancy that makes the big difference. When in the end of the month, other people in the building who are wealthier than you, they don't really feel the difference spending $3,000, $4,000, $5,000, $6,000 more than the previous month, where for you, credit card delinquencies are almost at an all-time high.